Focus. Ideate. Innovate. Enable. Kotak Mutual Fund presents Investmentor in association with Network 18.
Hello and welcome to Investmentor, presented to you by Kotak Mahindra Mutual Fund in association with Network 18. It is an investor education and awareness initiative by Kotak Mahindra Mutual Fund, and I'm Sonia Shenoy. Now on today's show, we will discuss balanced advantage funds and find out if an investor really needs balanced advantage funds to add to their portfolio. We will also be touching upon how to choose an ideal balanced advantage fund and how can these funds help investors create wealth. To discuss that, I've been joined by two industry stalwarts, Harsha Upadhyay, the President and Chief Investment Officer, Equity at Kotak Mahindra Asset Management Company, and Harish Krishnan, who is the Senior Executive Vice President and Fund Manager Equity at Kotak Mahindra Asset Management Company. Thanks, gentlemen, for joining us on the show. Harsha, let me start with you first. At a time like this, when the markets are a bit volatile, there are a lot of global headwinds as well. What is the advantage of investing in a balanced advantage fund, and what kind of investor should look at this fund?
Sonia, clearly equity markets at all points of time will have a certain degree of volatility, and equity investors should be prepared to wade through that volatility. But balanced advantage funds help you do that in a much better fashion. One way to take care of volatility and risk in the overall asset classes is to make sure that you have a prudent asset allocation, maybe between equity, debt, and few other asset classes. One can do that sitting with the financial experts, understanding the wealth, income, and the risk tolerance, etc. The experts will be able to guide each person in terms of what is the ideal equity, debt, and other asset classes allocation. Another way and a simpler way to do that is balanced advantage funds. And this category offers dynamic asset allocation between various asset classes. And generally it's equity and debt based on the valuations in the market and few other factors. And each fund house uses a different proprietary model to decide the allocation at various points of time. So essentially what it does is when the equity valuations are higher, you will have lower allocation to equity. When valuations are in your favor, then the allocation will go up. So this is going to help you manage the volatility and also make sure that you don't worry about the valuations, index levels, stock levels, etc. And those are taken care of by the fund house. That's the advantage of balanced advantage fund category. And on top of that, there is also a tax efficiency here because all these funds keep a minimum of 65% exposure to equity asset class. So they qualify under equity category for taxation.
Harish, come in on this. In terms of tax efficiency, how does a balanced advantage fund trump doing one's own allocation by investing separately in equity and debt funds? Purely, I'm talking about from a tax perspective now.
From a taxation point of view, as long as the gross equity exposure in the fund is more than 65%, from a tax angle, it qualifies as equity-oriented fund. Now, clearly, equity allocation in the fund can vary depending from fund house to fund house. Most of the fund houses typically vary it from say 20% to 80%. Some move from say 10 to 90%, etc. So whenever you have to go below 65%, what the fund houses use is through arbitrage strategies. So in arbitrage strategies, what effectively happens is you go long in terms of cash equities. So you essentially buy a particular stock in the cash market and you short the futures of the same stock in the futures market. So while from an end perspective, it is completely hedged. From a tax perspective, it is considered as gross equity exposure. And therefore, let's say that we have to take it down to 20%. We can still have cash equities, say at 65 or 70%, and we can be having an arbitrage book of maybe say 50%. And therefore, both these together take the net equity to 20%. But from a taxation point of view, it will be seen as a 70% gross equity that the fund is carrying. And therefore, one gets the benefit of having the tax efficiency of an equity-oriented mutual fund. Similarly, one also has a lower exposure to the broader equity market should the model decide basis valuation and other factors.
Harish, comment on the different kinds of balance advantage funds that investors can look at. What are the different models that are used, and which one is the most prudent for a long-term investor to take into consideration?
So, Sonia, as Harsha mentioned, most fund houses have their own proprietary model. So, broadly, if I were to look at, there are, I think, three vectors in which various fund houses differentiate the model. One is the range of equity exposure. Like I said, it can be 20 to 80, 30 to 70, 10 to 90. So that is one level of differentiation. Second is the model itself. Now, there are fund houses which follow a pro-cyclical model, and there are fund houses that follow a counter-cyclical model. Now, counter-cyclical model is basically as the markets keep going up and valuations keep getting higher and higher, you take down risk and reduce the equity exposure and be in various debt instruments or arbitrage strategies. And as the markets correct and valuations, etc., get in your favor, you increase back into equity exposure. So that's the counter-cyclical model in a very simplified fashion explained. The pro-cyclical model, on the other hand, is that as long as markets are good, let us continue to participate in markets. And through a model, say, whenever there are indications that the markets are likely to correct or there is going to be significant amount of uncertainties ahead, you reduce the overall exposure, and therefore you manage the overall net equity allocation through that kind of an exercise. So that is the second key difference. Now, obviously, each play to their own strengths. I don't think there is one view that can say that counter-cyclical is better than pro-cyclical or vice versa. But more importantly, I think it is also a function of the experience that the end investor kind of experiences. So typically in a counter-cyclical asset allocation, like Harsha mentioned, as markets keep going higher and higher, you want to take off equity and you want to reduce the possible drawdown that can happen, say, over the course of the next 3 months, 6 months, or maybe longer. Whereas in a pro-cyclical kind of a model, the idea is that let me try and participate as much as possible, given the contours of the ranges of the model, into equity markets. The third difference is, of course, how the model itself is constructed. There are different fund houses which have different models, clearly. Most of them seem to have some element of valuations as one of the factors, which is common, and it could be basis price to earnings, price to book, or it could be market cap to GDP. Any of these vectors or a combination of all of these vectors can derive the valuation scorecard. And then there are others. There is typically, fund houses that follow a second or maybe even a third dimension. It could be sentiment, it could be liquidity, it could be technical factors, etc., that arrive at how a combination of both of these 2 or 3 dimensions arrive at the net equity. So I think with the help of advisors, one can identify a particular balance advantage fund most suited to your kind of risk appetite, and therefore can consider evaluating them.
Is there a larger alpha by investing in a balance advantage fund rather than going for pure play equity fund or a pure play debt fund?
When you're investing in a pure play equity or a debt fund, you will essentially be comparing it to their respective benchmarks. So how they do would be or should be considered against their respective benchmarks. In a balance advantage category, generally you don't have full participation of equity, as I explained. So it will be a composite benchmark where there will be a 50% allocation to equity and a 50% allocation to debt. And then depending on when you go overweight, underweight on each asset class and whether it works or not, each fund may underperform, outperform that respective benchmark. But essentially going into a single fund has an advantage from a tax perspective as well. For example, if you invest in equity separately and debt fund separately, equity fund qualifies as a long-term investment just after 12 months, but whereas the debt fund will have to be held on for at least 3 years to qualify for it to be a long-term asset. Whereas if you take balance advantage fund, and if the fund manager is changing allocation between equity and debt, for example, it may happen in a shorter time period than 3 years, but still the fund is considered as equity fund simply because this category has a minimum exposure of at least 65% into equity, even when the direct equity or directional equity is less than 65%. Let's say it is 30% at a point of time. The rest 35% would be invested in arbitrage opportunities, which is going long on stock and going short on futures of the same stock. So effectively, you will have lesser equity exposure and maybe some arbitrage exposure, but still you will qualify for taxation as equity category. And since what happens in the rest of the portfolio, that is in the rest of the 35%, whether it is held as equity or as debt, that also qualifies as equity. So overall, for a investor who is looking for an easy to understand, no hassles kind of a fund, all weather kind of a fund, I think this category is a good category. It avoids all kinds of issues in terms of looking at the markets, trying to understand valuation, trying to see what is the prudent allocation that one should do at a particular point of time, etc. And all those decisions are taken by the balance advantage fund portfolio managers. So that's the advantage of this category.
Okay, all right. Very well explained. Let's do one thing. Let's take a short commercial break on Investmentor. We'll be back in just a bit to talk more about the benefits of investing in balanced advantage funds. Stay tuned.
Kotak Mutual Fund presents Investmentor in association with Network 18. Kotak Mutual Fund presents Investmentor in association with Network 18.
Welcome back. You're watching Investmentor, presented to you by Kotak Mahindra Mutual Fund in association with Network 18. It is an investor education and awareness initiative by Kotak Mahindra Mutual Fund. We have been in conversation with two industry experts, Harsha Upadhyay and Harish Krishnan from Kotak Mahindra Asset Management Company, and we've been talking about the benefits of investing in balanced advantage funds. And now, Harish, let me come to you on this. There are hybrid funds and there are balanced advantage funds, right? Just take us through the two.
So hybrid funds are essentially static asset allocation funds. So typically they tend to have an equity allocation anywhere between say 65 to 80% in equities, and the balance in various debt products. In the case of balanced advantage fund, as far as the net equity is concerned, like we mentioned, depending on the scheme, it can vary from 20 to 80, 30 to 70, etc. As far as net equities is concerned, and the balance would be in terms of debt products. One is a static or a closer static asset allocation product in the form of hybrid category, whereas a balanced advantage fund is more a dynamic asset allocation, even within these two asset classes of debt and equity is concerned. The balanced advantage fund typically has got an equity exposure, a net equity exposure of anywhere between 40 to 45%, whereas the net equity exposure in a hybrid category, let's say an equity hybrid category, would be more closer to say 70 or 75%. So as long as the overall markets continue to do very well, there will be greater equity participation in the hybrid equity hybrid category compared to the balanced advantage fund category. On the other hand, the volatility levels, because one is participating only about 40 or 45% in equity, will be significantly lower in the case of balanced advantage funds. In a typical 5-year cycle, there are anywhere between 8 to 10 drawdowns of markets, which last anywhere between 10 to 20%. Now, typically, drawdowns or volatility is something that investors worry a lot about. Whereas in a category like balanced advantage fund, actually volatility is our friend. So whenever there is a volatility or a drawdown in the markets, the overall net equity can go from say 25, 30, 40% all the way to say 60, 70, 80% and benefit from buying equities at a cheaper rate and therefore being in the faster compounding asset class at a cheaper rate, and then also have the discipline to book profits. So therefore, I would say that a balanced advantage fund category also benefits from higher volatility that the market presents. Of course, in the last 18 months, we've seen a one-sided move, and therefore it may always appear that equity markets are always the best choice. But clearly, if we take a longer term horizon, we all know that every asset class goes through its own cycles. And therefore, if we look at it in totality, with a similar kind of a tax treatment, I would say for a first time investor, possibly a balanced advantage fund reduces some of those characteristics of wanting to identify asset allocation, valuation frameworks, etc., and therefore can be an easier choice to enter in the overall investor mindset.
Okay, Harsha, any thoughts here?
I think Harish has explained it well in terms of the risk return profile that each of these categories will have. I would just supplement that in hybrid category, you also have hybrids which are debt oriented. In those cases, the equity allocation is much lower and typically lower than balance advantage funds on a cycle basis. For example, a debt hybrid will generally have about 25% exposure to equity and the rest of the exposure to debt. So in that context, debt hybrid funds will have the lowest volatility among all three. Equity hybrid will have the highest because it will always have more than 70% exposure to equity. And balance advantage funds will be somewhere in between, but will still have equity taxation benefit. Whereas the debt hybrid category may have the lowest volatility, but it will not have the tax advantage because 65% is not invested into equity in that case. So these are three broad categories of hybrid funds. And within that, balance advantage funds are the only ones which use dynamic asset allocation to the truest sense, I would say. While debt hybrid and equity hybrid can also reduce or increase equity allocation, but that range is typically very small.
Can balance advantage funds help investors create wealth, especially at a time like this when the market is close to an all-time high? It's come off about 10% from the highs. When, there are a lot of headwinds now, right? I mean, there is higher interest rates, there's high inflation, there is a lot of growth risks as well globally. At such a time, Harish, can the investing in a balance advantage fund, can it help investors create wealth?
So I think wealth is created by being in the right vehicle as well as giving time for that vehicle to compound. Now, let's take the three categories and broadly, if you were to look at, say, the doubling time of a fixed income product, depending on, obviously, let's take the simplest fixed income product, which is, say, an FD in a nationalized bank. That would be, significantly in the double digit in terms of the number of years it takes to double the wealth. And depending on the FD rates and the taxation slabs that the investor is, it can take, significantly anywhere between 15 to 20 years to double the wealth. Now, equity markets, on the other hand, typically, if you take the case of, say, something like a Nifty, etc., has got characteristics where it can double even within less than a year, like what we have seen at the if somebody had invested in the low of March 2020, one has seen a doubling time which is less than even a year. But those are very, very, very rare exceptions. Generally, it varies, has a very wide range where investors can double the wealth. Now, a balance advantage fund gets the benefit of having a narrower range compared to both, pure fixed income or fixed deposit kind of investor, as well as in terms of a pure equity investor. And that really is, I would say, the benefit of looking at balance advantage fund as a vehicle to compound wealth over, long cycles. Again, we are talking about 5-year, 10-year horizons. And to your point as to the current structure of the markets with the volatility and the various variables that are there, like I mentioned, a balance advantage fund typically embraces volatility. More the episodes of volatility, greater the chance that a balance advantage fund has the ability to increase allocations to a better asset class in terms of equities, in terms of its compounding characteristics, and therefore higher the volatility, better it is for such an instrument. So therefore, in totality, if you were to look at all of these characteristics, the simplicity, the tax efficiency, as well as the fact that it generally embraces higher volatility in markets, I would say that generally balance advantage fund has a place in the investor's portfolio, clearly in terms of compounding wealth over the longer term.
Okay. Harsha, if one has 100 rupees to allocate in the market, how much would you recommend one allocates to balance advantage funds versus, say, pure play equity funds?
Sonia, there is no one size fits all kind of a solution here. I think, the one way to do it is deciding allocation between equity and debt, and let's say somebody decides 60-40, then you can put 60 rupees into equity funds, 40 rupees into debt funds. But it will have the headache of choosing a few equity funds, few debt funds. And as I mentioned earlier, the tax advantage is also unlikely to be there. But if a person wants a hassle-free, easy to understand kind of a product and still want to have the tax advantage by taking a gross equity exposure of 65%, but at times the net equity could be lower than that. If such a category is looked at, then I think, some investors can also put all their money in balance advantage funds. I mean, they need not do any asset allocation on their own, but they can leave it to the fund house to do that. So both approaches can be used depending on how conversant one is about equity, debt, and various parameters which decide valuations and moves in the market. But for those who want a very simple hassle-free product, I think balance advantage category is a very good category.
All right. Well, Harsha and Harish, thank you so much for joining us. This has been a very informative session. And thank you to all our viewers as well. With that, it is curtains down on Investmentor for this week. Keep watching CNBC TV 18 for more action.
Kotak Mutual Fund presents Investmentor in association with Network 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus, ideate, innovate, enable.